wait a second. Are tariffs actually good for the multifamily industry? Well, some say yes. According to a Wall Street Journal article, Dr. Matt Bosnagel is saying maybe not so fast. So we're going to debate that. Are tariffs good, bad, and different? What's the nuance of this tariff debate? We're also going to get into just the idea of a weakening U.S. dollar related to tariffs, related to multifamily, and how have previous cycles of U.S. dollar weakening affected the U.S. real estate, but specifically the multifamily market. Going to strap in. We've got a great episode today. We're going to keep you up to speed on some multifamily and residential construction data. And Matt and I, we're going to be going back and forth on this tariff dollar multifamily debate. We've got some disagreements. Let's get into it. All right, let's go. All right, welcome back to the Gray Report. I'm joined again by Dr. Matt Bosnagel. He's Director of Communications and Marketing here at Gray Capital at our headquarters in Indianapolis, Indiana. He's been holding down the fort the last couple of weeks. I was out on spring break, and I was sick with the shingles and all this I'm back. I'm ready to go.
Nice.
Talk about multifamily. And
It's good to be back on this side.
Yeah, it's very good. Yeah. Last week, Matt, was insane.
I thought it was a good episode, yeah.
Good episode. The markets, though.
Oh, yeah. Okay. It was an insane episode because the markets were insane.
It was a great episode, but the markets, again, I was in and out of, twilight last week trying to recover, but then I'm turning on, Bloomberg.
You don't know if you're in delirium or not?
I wasn't sure. I was not sure when I'm hearing comments from the media saying that we've got 2008 like feelings and vibes, and volatility is never seen. We're at kind of peak volatility since the pandemic, and consumer confidence is at levels, investor sentiment is at levels that we haven't seen since the 2008 financial crisis or the pandemic. It really has wondering kind of again, where are we going to go, but how do we plan for the future when things change so quickly? We had the stock market down, by 6% one day, then up 12% the next. Tariffs were on, and then exemptions, were given just days later. And so for those of us that aren't traders, because if you're a trader, you can make or lose an incredible amount of money right now. I learned a long time ago that that's just not what I'm good at. Making long-term investments, with a good time horizon, something that we can operate effectively to kind of control our own destiny a little bit.
Well, and I think that's in the mind of a lot of investors at this point. We'll talk about the broader implications of that statement, but I think people are looking for more stable investments. And there is a case in general to say that they're coming to CRE, and that's been the murmuring, in a lot of the kind of commentary and opinions on the commercial real estate these past couple of weeks is like, oh yeah, well there is a logic to this. I think it's a little more complicated than that, and we were talking about before. It may be a case of what is the relative benefactor of this, right? Like the least damage as we go through this gauntlet than the one that comes out on top.
And what's going to be the least damage, I think, is a good point. And then what has the legs to actually outperform once we get through it? Which assets are going to be the beneficiaries in the next cycle? Because if we're not in the midst of some sort of trough right now, or market correction, whether that's multifamily, if that's public equities, I don't know what that looks like, but there's definitely reshuffling. So getting on the other side, what's going to perform well? The challenge is, we don't know what the other side is going to look like. But that's where when we come back to residential real estate, and the attractiveness of investing in residential real estate in general is that it's a necessity. Everyone has to have, or strongly prefer to have, some sort of shelter over their head. And so we know that there's going to be demand. The demand numbers actually for multifamily are really encouraging right now. I think Q1 rental demand guys talked about it last week. It's some of the highest first quarter rental demand. And what was it, over a decade or so? Just incredibly strong.
And that's been underlined for both the economy and the multifamily market. We've been meeting this moment of uncertainty with things that were fairly healthy and stable. And looking back at it, especially, it's funny, in January, kind of where all these things were a glint, I guess, in the eye of the Trump administration, people were talking about a persistently high federal or 10-year treasury and federal funds rate because of continued inflation worries, because of like an overheated economy. And now the inflation may be coming from a different way, and things are a lot more uncertain, at least. It's just interesting, the story of contrasts and the challenges that are still going to be here. But the absorption levels for the first quarter, RealPage, it's the strongest than they have ever recorded. So
Yeah.
there's really good reason to think that the multifamily market specifically is getting out of its stagnation because of the oversupply. Like, it's well behind us, I think, although the numbers say that we're just still headed down.
Yeah. So caveat for a recession, because if a recession happens in the short term, near term, then you kind of calculations are off and we have to kind of reset things. But regardless of even that short term impact, we can be relatively confident about rental demand over the next, call it 5 to 10 years. The big challenge for multifamily investors is not that there be demand. It's demand relative to supply, but values are too high. Values have to come down. Interest rates have to come down.
Yes.
Or rents have to go up. Now, with that strong rental demand, we can infer that we will see rental rates increase over time. It's just the when is a big question. We're getting off this major supply wave, maybe some even further reduced supply because of tariffs and weak dollar, some other things that we were going to talk about in a little bit. But to take advantage of the market and the potential growth, you got to get past, again, the values, the rates, or the rents.
Yeah.
And because rents haven't risen enough to get past the rising interest rates, and values are still high, cap rates are really low, so it's very difficult to transact. And most buyers, most market participants aren't really sure where things, should be. There's a lot of different opinions, and there's been more bullish market activity than distress. But then there's this feeling, more than a feeling, of this percolating distress that's under the surface. Yeah. We all know the projects and the deals, the developments that are just hanging on.
Well, look at the example of the Trump tariffs. The markets didn't crash until the moment it hit. So people, even though they know it's coming, they may not act on it, and they may until the reality really is in. It strikes me, and I have listened to my fair share of podcasts and interviews about this, that no one's really talking about wow, they sure did wait until the very second when these things were enacted to actually buy and sell. No one really knows. And
we were also convinced that it was pure negotiating tactics, right?
Yeah.
And everyone was like, none of it's real. He's like, they're not serious about it. They're not actually going to do it. And we talked about a month and a half, 2 months ago on the Gray Report of saying this is clearly an issue. If the whole world knows that they're just jockeying for position and leverage,
that's true. So that clouds us a little bit.
They will then have to take certain action to convince the world that they're serious.
Yeah.
And what's happened?
Yeah, I know.
Now everyone's like, "Oh, are they serious?" And now no one knows, because then they've come off of it and they've given exceptions.
I know.
But there's less talk about it's less. This is only for negotiating, and how much of this is negotiating?
Yeah,
and which of it is actual real?
Because it sure seems like this 10% baseline across the board tariff over all these goods, no matter what it is, that seems like we're not talking about it that much. And for that reason, I was like, maybe the other tariffs were a distraction from this baseline.
Yeah,
and that's as high as tariffs have been since the 40s.
They just hit a high anchor. Basically,
yeah.
It's like, you don't like that? Okay, we'll double it, triple it.
And my
original offer seems a lot
what
better.
I discussed a lot with Addison and I think Jay too in the last couple of weeks was that we don't have a sense of the goals, and some of the goals and reasoning behind it are a little bit contradictory. So, and even it's hard to think about what the specifics of a deal with another country and all these individual deals that are going to be negotiated. What's the goal? That I know what a kind of general goal is to the benefit of American trade, but I don't know what the grievances are beyond the fact that it's a trade deficit. And
I think simply, I think it's a tactic with sometimes there may be some specific asks and things to get, but I think many of the cases it's let's see what we can get,
Yeah.
and we will end up
Yeah.
in a better position at the end of the day than when we started.
Yeah.
I think is the belief, but I agree, and that we don't know what the goals are, and it's hard to support something that where we don't know what the objectives are because. I've heard that this is to get us to free trade. We're going to have these tariffs, so we negotiate better trade deals and to reduce trade barriers, so we can go to like no tariffs in the future.
Yeah.
It's like okay, backwards way of getting there.
Yeah.
But like I agree with that. That goal sounds attractive, and it's a tactic of saying, look, everyone else has tariffs, everyone else has these policies. We've got to fight fire with fire, and we've got leverage, and this thing we can get down to like a more free trade economy. I don't think the Trump administration are big free traders though. They're literally for fair trade,
Yeah.
and which is much more really kind of like the Democrat position or the liberal, even though it's not liberal position, back in the mid 2000s and through the 90s, like more fair trade. But or is it to raise revenue? Because then there's also this talk of Doge is going to reduce the deficit by $1 trillion a year, and we're going to raise revenues by $1 to $2 trillion a year.
Yep.
And looks like the tariffs at the 10% rate get us to around that $1 trillion of additional revenue. But if we're using these tariffs as negotiating leverage to get down to zero,
Yeah.
well, that doesn't matter. But they seem pretty serious about
Yeah.
the revenue side of it.
Yeah.
Because they're like, from a business perspective, obviously, we've got to raise revenue and cut expenses. We don't want to raise taxes in the way that we typically think of taxes. So we have to have another form of tax, essentially, which are tariffs.
Supposedly, the argument is you raise revenue from that, and then you slowly are industrializing
Yeah.
your own country. The
Well,
U.S. the United
that's
States
the third goal.
is slowly industrializing. So you kind of do all at once in some kind of magical.
And that is
solution
happening. And I mean, we're seeing countries and companies agreeing to build things in the United States. Like that is happening. It takes a long time to happen. Like China just banned the export of rare earth minerals yesterday.
Yeah.
We need those to build cell phones. We need those to build advanced military equipment for all kinds of technology. Now, does that? But we have a lot of those rare earth minerals in the United States.
They're everywhere.
Well, they're not everywhere.
They're everywhere in small quantities.
But we have them in large quantities in the United States. We just don't have any processing capacity.
Yeah. Okay.
Huge investment. It can be dirty thing in some cases. I mean, we're talking mining, but we've got the stuff here. Is this then the impetus to actually be more self-sufficient in terms of having access to critical natural resources, of where the status quo is we are reliant on a economic adversary in China. But again, but you and I, it's being left up to just discussions and trying to figure out, and everyone can kind of put their hopes and dreams and their vision on on tariffs.
Yeah.
Spin it in a positive light if you so choose to.
Yep.
And that's hard to. It's a lot to hang your hat. It requires a lot of faith.
Yeah.
A lot of faith.
And it is. I've heard this enough so that it's become kind of a cliche, but it is a reordering of global trade, and so you gotta think that there's going to be some kind of effect, and this is the most uncomfortable moment where we don't even know how. We haven't even felt the prices change, like buying grapes at the grocery store or whatever. That hasn't hit people's wallets yet, so. We don't, so it's hard to conceptualize this, but I still keep thinking back to maybe people are just going to wait until the moment where there's no turning back, and then that's when they're kind of going to react in the same way that they were just an idea, then they were reality supposedly for that week, and then the markets reacted. And just to loop this back in, we were talking about multifamily operators and owners, and I got us all sidetracked, but I think it's good because I wanted to establish the environment that we're in. But like multifamily owners, well, if they have a problem property, are they going to wait until the very last minute? And I think that they kind of will. They'll try to keep it as live with as much strategy and as much work as it's possible before they'll capitulate.
Yeah.
And so I don't know. I asked Addison this, and I was not really optimistic that the answer would be yes. But are there going to be any owners, whether they're owners of problem properties or not, that say, wow, I guess I want to sell earlier rather than later, because if I sell later, the prices will be a little lower. A lot of what I'm thinking about this moment too is that it will be transitory, because it is very difficult for me to imagine this lasting long. I agree that the disruption is going to have long-lasting disconnections, and repair needs to be done to whatever supply chains were broken as a result of this tariff. But that being said, again, we were strong going in, and hopefully this will be transitory until we figure out what the goals are.
Yeah, I mean, I can see a possibility of near-term great weakness.
Yeah.
General economy, also multifamily. I mean, I think there's going to be demand, but if we do hit a recession, we're not going to see a ton of rent growth.
Mm-hmm.
I mean, wages and employment are at a healthy place right now. The Fed does have ammunition to bring rates down. So like there are tools. So I don't think a recession is going to be too bad. I mean, J.P. Morgan just came out
I read that,
with a piece on not just CRE debt, but also basically how corporate balance sheets are in relatively good position. So I think we're relatively as well positioned as we can be, not knowing like the black swans out there. But it's still not going to be a good event. But long term, again, looking at coming back to multifamily, just because that's what we know the most about. We've got a pretty exciting time period getting out of the near term.
Yeah.
It's most likely going to see some rent growth because we're not going to see a lot of supply. Tariffs may reduce further supply even more. As the dollar weakens, as it has been weakening, we could see more foreign investment coming into the United States as U.S. assets are on sale. And as much as that there's a anti-U.S. sentiment maybe today, money is going to speak a little bit louder than that sentiment at some point. So you're going to see value appreciation over time. You're going to see rental demand, continue to stay high. So we're going to see some rent growth as supply falls off a cliff. So over the long term, it looks pretty attractive. It's just, again, how do you get in when you have to dodge around a potential recession and going back to interest rates, values, and rents today, not making deals make sense.
Well, and this is what I was also thinking while you're talking about it, and is like, what about that owner of that troubled property, or any owner of any property that has near-term, that is currently facing kind of near-term struggles and a near-term deadline, where not enough runway to get it before maybe a loan maturity, or to really like he or she's been limping along for the past few years. There could be this kind of confluence, and this crisis will expose those, and it'll be interesting to see what opportunities arise, because a lot of this has been bubbling up for the past 2 to 4 years.
Yeah, and I think a lot of the upside, the silver lining to a lot of this is not going to be in play soon enough, really, to help some of the most distressed borrowers. I mean, again, if we hit a recession, I don't see the rate drop isn't going to come first. You're going to see we're going to be in a recession. You're going to see rents flat or declining. You're gonna if we have expenses rising, we could be in a stagflationary environment. So operating expenses are going to be going up. That's not going to allow someone to easily refinance if they can't refinance today. Yeah, I mean, if rates went to absolute zero, would certainly help in many cases, but it's not going to be a cure-all, and rates aren't going to go to zero. Well, I mean, they could do it in a day, but it's not happening, immediately.
Yeah, for sure.
so if you're in a tough spot, it's going to be hard to get out of it. But if you have some duration, if you can get into 2026, maybe you'll be all right. And a lot of the loan maturities, I mean, there's a large spike, especially in multifamily at the end of 2025. But as we've looked, we've got a whole research report on upcoming loan maturities. Find it, graycapitalllc.com. We know that there's quite a bit in 2026 as well.
Yeah.
And so there's a chance that that there are some owners and developers that have loan maturities that might be saved if rates are dropped because of a recession, and they get past the volatility of a recession and take advantage of some of the upswing.
Yeah.
But recessions typically last what 6 to 18 months.
Yeah.
With the average being kind of like 9 to 12.
It's just increasing all these dice rolls that you gotta roll. A little one more variable. That's can you make it that long, and or are rates going to improve, or is the pricing going to be in line? There's a lot of things that could happen, and a lot of them you don't really know what's going to happen. So that'll be an interesting challenge, interesting thing to watch. And I'm not sure like we've always said, I'm not sure this is going to make or break the market, but it sure does place pressure on some like a non-zero amount of these borrowers. We've been tracking a longer term. There's some information, I forget the exact source, but increasing amounts of delinquencies and special servicing amongst multifamily properties and multifamily borrowers specifically. So, and that was a relatively long-term trend. So it'll be interesting to see how that develops.
Absolutely. All right. So just looking a little bit more at this actual Wall Street Journal article that came out on April 15th, which is the day that we're recording this. Matt, again, you put in the notes, basically being a little more cynical about the article. And there's a couple pieces to this, which is this similar commentary when like the Wall Street Journal writes an article about multifamily because it's often like a degree separated from the industry.
So I was knee-jerk. I was contrarian.
That's okay. I'm curious first, because I can see both sides to the argument, and I'll take the journal's position just for the sake of the argument.
Yeah.
Just what were your issues or the thoughts, and then some other thoughts of some other industry folks of how tariffs, like let's not be too quick to say tariffs are a good thing.
Yeah. Well, I think that. So I'll just take as a jumping off point this quote here. It says, the multifamily industry can pause most construction ahead of potential tariffs on building materials. That's the subtitle of this, the subheadline, I guess, of this article. And
what is that? I was confused. But
so I like the word choice, can. So ideally, I don't think builders want to stop building. So that undercuts the headline somewhat. But I think that they're already framing this as a benefit to developers, seeing kind of the silver lining that, well, man, we overbuilt, and now we've got these tariffs that are going to prevent people from building, which is going to drive rents up, and because it'll lower the supply that gets delivered, and it'll drive rents up and it'll benefit us developers because we really want to get these things filled up with renters.
Their developments at the end of the day are going to be more valuable.
Yeah.
Because there's going to be less of them.
And they're talking about the cost of the renting on one side and the development on the other side. The rent's got to be higher than development, and that may mean that projects don't move forward because of that cost difference due to tariffs. But the point is, the people that are building right now, when they finish, maybe they'll be in a little better prospects than they would have because of maybe the implication here is a even stronger drop off in apartment starts or apartment permits, apartment construction.
I mean, the big story that the journal is trying to make is, look, new supply of apartments was coming down after a 50-year peak, and so most were of the opinion that will at some point drive some revenue, some rental growth, and assets should increase in value just because there's going to be much less developed. Yeah, that's not necessarily going to save the folks that are facing a loan maturity in the next couple months. Yeah, but it does make sense though that, look, over the long term, it's more expensive to build these things. Yeah, it used to cost, and I think the article, let's say it costs $250,000 per unit to build a multifamily property, but now it costs $300,000. you've essentially baked in to rebuild that. There's 50K of profit that you're cheaper than the competition. So you theoretically should be able to sell that closer to 300,000 per
Good
unit.
point.
So, there should be some, value creation just from a reduction of supply.
And I was
That makes
thinking
sense.
I was thinking of more of it like, let's say you got 3 apartment buildings that are going up in the same area. If that price goes up per unit and one of them can't afford it, then the other 2 existing ones can charge more from renters. I was just thinking it more in terms of like which are going to move forward and which aren't. But I think probably more likely it'll shake out, especially in the investment market, where they will be able to sell for a lot more than maybe they would have.
Well, that's where I think the headline kind of misses like the actual effect of. So the true beneficiaries, I think, the tariffs aren't really the developers. I mean, there will be some because like if you're the only one delivering and you're able to make sense of it and you're able to get the equity.
And there was a developer that said he would.
Yeah, they all say they say they will. For we'll get into that in a second. But the true beneficiaries are those that are buying existing assets or who already own existing assets, because you got your basis already locked in. And so if you've bought an apartment community for $150,000 per unit or $100,000 per unit, and to build something new it costs $300,000, well that's a huge spread. And the spread between rents, while there is a spread, is not as wide.
Yeah.
And so you can get some really attractive, cash flowing opportunities on your existing assets. And then because of that, at some point, that arbitrage is going to be, shaved off.
Yeah.
And the values of the existing assets are going to rise to not meet the cost of new construction, but be back to like a relative spread between existing assets and new construction. Again, all this doesn't happen overnight. And we have to have a working market to start having more price discovery for this to actually be realized.
Yeah.
And so, again, it's like this, it's a little premature. It's like this could be absolutely the story in a year and a half or 2 years from now. But we have to get through this current period of volatility.
Yeah, and that was another kind of criticism that I had too, is they should also acknowledge the difficulty that it's probably going to be on operators if these tariffs are enacted. Not all parts come from the U.S., and there are probably some materials costs of just simple maintenance and operations may increase expenses for apartment owners.
Absolutely.
So a lot does rely on rent growth, and I think that that's something that when I was thinking about these sources, and just for the past few weeks, I guess, as supply rush has gone down, I've been rolling around in my head like, wow, we got to pay attention to other stuff other than apartment supply. So maybe population and job growth are going to become more relevant. But the way that this goes, it's supply. If I think one of the underlying premises of this Wall Street Journal article is the apartment oversupply is going to hit. The tariffs are just going to cause the brakes to be hit so much quicker than it would otherwise, and that may benefit developers in some way that they frame, and we've just explained.
Yeah.
But I think that would be an interesting and I think not unlikely upshot to tariffs. We'll have to, on a deal-to-deal basis, determine on which developers are going to benefit.
Getting back to the point that you had made or found it interesting in the article, they interviewed a developer.
Oh yeah,
who basically said like he's the one developer that's cutting against the grain that is deciding to continue to build. And I chuckled when I read that, because I'm like, every developer I speak to, they all say that they are going to continue to build.
Yeah,
and part of that is because they all want to continue to build, partially because that's what the business they're in, but also most developers rely on development fees to like stay in business.
Yeah.
Like the upside of selling a property, well, you might not sell a property for years, but you typically can't like live just on selling a property. You have to have those residual like development fees coming in and doing a project.
Okay.
So if you don't do a deal, like if you're not going to build this year,
yeah,
a lot of groups you're out of business. And so when you ask a developer, are you still planning on building this year or next year?
Yeah.
Anything other than yes is, I'm actually planning on going market.
Yeah.
I'm getting ready to go out of business.
Yeah.
So no developer is going to say that we're not building. They all want to. It's just that can they find the equity, the financing, the dollars to actually do it is a big question. Which again, with a weakening U.S. dollar, U.S. assets go on sale, we might see a inflow of foreign capital. Again, the United States maybe not as attractive today because of politics. But just doing a little bit of research, I mean, like in the late '80s, from like mid '80s to the late to early '90s, like Japanese investors and other foreign investors, they made up 30% of multifamily investments over that period, mostly driven by a weaker dollar, which contributed to increasing of asset values. Because in their mind, the yen was so much more valuable than the U.S. dollar. They can go in, take their currency and arbitrage by cash flowing real assets in a stable economy, stable market that is the United States, and even just given just some of the volatility we've seen. I know it's all crazy and we look like an emerging market. I think most of the world has confidence in the United States over a long-term period.
Well, and even just talking about what foreign countries hold the amount of U.S. debt. Number one is Japan, as you noted, and it's far and away above the other. The next one is China, but China's more or less tied with the U.K. And if you go down the list, it's very interesting. I think the third is like Luxembourg, and the Cayman Islands is up there too, which is like, well, I wonder who's in there.
Tax havens.
It's not necessarily correlated with the size of the economy necessarily, especially in Japan's case. But that is another layer of uncertainty that I think is coloring a lot of the discussions, a lot of the thinking that went into laying this.
The last piece, though, just while we're on the topic of winners and losers of tariffs, because again, we were talking before we started recording, it's not necessarily all good, all bad.
Yeah.
There's probably going to be some beneficiaries. There's going to be some losers, regardless of how the policy ends up shaking out. The Midwest still seems to be in the sweet spot.
Yeah.
Things are relatively affordable, already not that too expensive in the Midwest. Stable markets, some of the best performing operationally multifamily markets in the nation the last several years. But also Midwest is prime to take it if we do this onshoring of manufacturing. The Midwest is primarily where that's going to happen. It's going to be other places. It's going to be in Arizona too, but it's largely going to be in the Midwestern United States because they're affordable markets. There's room to build. It's relatively business friendly. Get permits to do it.
Yeah.
So there are definitely some beneficiaries, in the Midwest, which will be really, really interesting.
Yeah, and just the overall stability. It's also worth noting, along with the economy facing this uncertainty, there are some places that are way more volatile than others when it comes to the apartment market.
I mean, I think if you're looking for a safe harbor investment, where can I get some shelter from the storm? I think Midwest multifamily at a reasonable price. I say that at a reasonable price because you got to buy it right.
Yeah,
seems like a really good place to be. Speaking of other markets, Matt, I like this transition. Okay, markets best suited for investment in 2025. Now, this John Burns Research Consulting put out a list, and it's not necessarily the best markets, we'd say, but it's some markets that you had a couple different takes. The headline is, where will new home construction go beyond the usual hotspots? And they call the usual hotspots California, Florida, Texas, Georgia, Arizona, and New York. We're talking about some other MSAs that I would call these all relatively large, but are kind of maybe the up and coming construction boom markets.
Yeah.
But your point, Matt, when we were talking about this piece before, is you're like, these aren't necessarily the markets that you want to jump into just because they're building new housing units, which means there's some demand, but you also need to watch out because they're building more units.
Yeah, I will admit, like, as I started gathering these, I gathered it quickly. I was like, oh, this is interesting, and from skimming the article, you almost jump to the conclusion that these home construction growth equals housing demand, because it does kind of connect the two implicitly. They have the numbers of housing permits and for single family and in multifamily, but then they follow that by a list of like the demand drivers. For instance, they talk about Charlotte that ranks 7th in permit activity, and then they follow it with Charlotte's strong banking and finance sector continues to attract high-paying jobs. Now that's great. And then they say, in response to rising housing demand, developers are shifting focus to multifamily as infrastructure struggles to keep up. That's fine, but you don't get the numbers. And if you looked at the numbers, you would see that Charlotte is one of the more overbuilt markets. Yeah. And we're going to talk long-term, short-term. That means it's going to be a short-term oversupply and maybe has long-term legs. But if you're going to try and weather, that means probably for the next 2 or 3 years, Charlotte's probably going to be oversupplied. That would be my guess.
Yeah. I mean, coming back, I mean, just circling back to what we were just talking about, I mean, if we do see a further reduction in new supply in these markets, I mean, that could, if that happens, that could be what some of these now high supply markets could really need.
Yeah, yeah.
And some of those developers may be saved because all of a sudden, you're building a lot right now, but because there's a lot of demand.
Yeah.
If we can't build anymore because it's too expensive, that inventory most likely will be absorbed faster than if we have a further glut of new inventory, because let's say that rates come down and tariffs aren't that impactful and housing cost and the cost to build stays the same or even comes down a little. Let's just say it stays the same. We're probably going to build a lot more housing units.
Yep.
And those markets are not going to perform as well from an investment standpoint in terms of rent growth and all of that. Now for residents, for renters, that would be a good thing, because we want the supply to keep on cranking. We want to keep on going. And so, again, this is where it's the tale of two cities, and it's how we're looking at it. The conversation that you and I are having is different from those of city leaders of how are we dealing with this affordability crisis and housing availability, and they need to keep building in these markets.
They say there's a lot of housing demand. There's also a lot of housing supply. And that was what my thought is that's great. They are going to build and they're meeting that demand. My question is, are we getting to this point? And like you kind of mentioned before, because of the lower supply, are we getting to this point where that permit activity, that's relevant, but also the strong job sector, or the strong economy, the strong, what do they say, banking and finance sector, that's equally relevant. But I keep going back to the past 2 years, all we talked about was supply. That was basically the only relevant thing you had to follow because we were building so much. But now that things are coming into balance, well, you got to follow banking and finance now, or at least makes it more interesting.
And that's how it typically often is. I mean, you're always looking at supply.
Yeah, and you don't want to do it in a really, really dismal market too. Sorry.
Yeah. You don't want to invest in. I mean, it's always a balance. You don't want to invest in a market. You want to invest in a market that's growing, but not growing so fast that it's attracting every developer to build an added glut of new supply. Definitely true. You don't want to go in a market that's just declining also for too long, because even though you might be the only game in town, at some point, you're playing hot potato and you're going to be in a market that at the value of that asset is actually declining or trading at a higher cap rate.
What I do think about this is
how many think that these permits will actually be built too? I mean, just because it's permitted doesn't mean it's going to be built.
Very, very good point. And for a while, I lacked the statistical number manipulation experience but I'll run it through ChatGPT, but to find what's the attrition rate, I guess, of a permit. Do 80% of all permits issued end up in completions, or is it 50%?
RealPage has done some research on that.
Okay, I'll have to.
But that's often in the difference between different supply forecasts is the assumption on permit attrition.
Yeah. And that would be interesting to see that number fluctuate over time, and maybe, arguably, the tariffs are going to be one of those disruptors that increases the permit attrition.
Yeah, exactly. It made sense. You got the permits, and all of a sudden the costs went up by 30%, 40%. I mean, costs often, in the pandemic, were going up by 15 to 30% of construction costs. So it's not outside of the realm of possibility by any means. And just an example, going back to, again, sort of similar time period of where we went from high supply to low supply relative to kind of a stagflationary environment, weakening dollar, going back to this theme, 1985 to 1991, we went from a peak of multifamily deliveries of 650,000 annually to only 175,000 units annually.
Yeah.
1985 to 1991. So it's over, basically 5-6 year period. So it can take a while long to get through that cycle.
Yeah.
But we also started seeing a lot of rent growth during that at the latter half of that 5-year cycle as well. So again, that's just an example in history. It's really not the same, but
But it's an interesting
rhyming example.
Yeah. That's really interesting. The timing of that cycle too. Of like it takes about 5 years for things and we're right now like, going down that hill, I guess.
Yeah, patience is a virtue right now. Matt, this brings me to the CBRE piece, which I really like the idea of. This is in their chart of the week. It's from just a couple of days ago. I am clamoring for more details.
We have contacted the author.
Okay, good. Okay. So we've reached out to Mike Leahy, who we've covered a handful of his pieces. It's got a good mustache, and so we know we can do some good work. But a really great graph. But there's all these blank boxes I want to know. Yeah. So anyway, this piece is it reminded me of that Berkadia article we touched on like 2 or 3 years ago. But it's talking about portfolio construction related to multifamily investment, which big passion of mine, looking at not just investing in an asset, but building a diversified portfolio of cash flow in multifamily real estate. Get so excited about talking about this. And they're talking about diversification and pairing different markets that are correlated or uncorrelated to the broader multifamily market or just broader market in general. Yeah. And talks about a lot of statistics, to go into of markets that, are correlated or uncorrelated to each other and what those return profiles of those different paired markets could be, but really doesn't give too many examples other than markets that kind of fall outside of that are kind of outliers and that don't show as much of a correlation or non-correlation. And so Mike, we'd love to have you on to talk about this or just to see more of the data. So we'd love to dig in and do some comparisons on different markets, not just different markets, but different asset classes. Yeah. So like, Washington, D.C. apartments with maybe paired with a Houston apartment investment. Yeah. That blended risk and return profile is just a really interesting concept and something that investors should think about when they're making allocations, not only looking at the deal, and the deal is really important, just like the sponsor is incredibly important. Like the deal's got to make sense. You can't just be like, I need to find an industrial deal in Los Angeles somewhere. Yeah. It's got to be the right deal, but that right industrial investment in Los Angeles with the right apartment investment in Houston or Indianapolis could have a really interesting risk and return profile that protects from the downside, but also allows you to take advantage of some potential upside. Yeah. And go ahead.
And no, it's funny because that's what I was kind of thinking of, like these examples of markets that, the apartments in one and the industry in the other. But I was also thinking like on the counterexample, there could be markets that are maybe dangerously correlated for whatever reason. Like what if you get the apartments in one city and then the close by you get the industrial in another city, but like when one tanks the other does because all of the people that worked at the factory live in the other one. Like that's a very basic example.
That's what you want to be that's what you want to look out for. You don't want to be in an overly concentrated position. And whether it's geographic concentration, asset class concentration, or as people have learned recently, sponsor concentration. Yeah. There have been just some sponsors that did just a lot of bad deals in different markets, and you could invest with that sponsor and been sort of geographically diversified. I'm thinking of a couple of different kind of high profile sponsors. Yeah.
But if there's
all
articles, correlated,
Tides Equities, GVA, that were heavily invested in the Sun Belt or kind of like Tennessee, Southeast. Yeah. Diversified across different markets, but they've ended up having to hand a lot of those properties back to the bank or the lender because it ended up not working out.
Well, because I would argue that some of these apartment markets, like I sometimes would lump in, this was early in the pandemic, the Sunbelt markets with like Boise or Salt Lake City or like places where you want to go and hang out or like attractions. Yeah. And they had the same rough pattern of apartment supply and like huge demand and then the falling off demand. So there are interesting ways and interesting intersections. And, I'm also thinking, well, if you're talking about like maybe commercial or office space, maybe San Francisco is correlated with like San Jose or something as like tech capitals. And
yeah, exactly. Industry overlap. But also just again that risk profile of like the ability to take some higher risk investments, but you're pairing those with some lower risk, more stable allocations as well. Yeah. And so you're protecting from the downside a total loss on the riskier investment might not mean a total loss of your overall CRE portfolio. It may mean an underperformance, and you're getting a 12% total return rather than 15 or 20. But if that riskier investment hits, you are potentially able to significantly outperform the market, but more of your stable investments acting as a balance to the overall portfolio. I think it's a good exercise to think about, again, not just I'm investing in multifamily and in this market with this sponsor, but thinking about, all right, I'm going to make allocations to build like the right risk and return profile for my goals and objectives. And again, maybe that California or New York or California, last mile industrial paired with suburban, Indianapolis multifamily is really exciting, or even some midwestern multifamily logistics with maybe even like an Austin, Texas. Like I'm gonna take a flyer because Austin, I think the values might be really down in the dumps in Austin. But I think there's going to be a lot of growth and cap rate compression. So I'm going to take a flyer on Austin, but then I'm going to do some stable investments elsewhere and see how it all works out. Or you go all stable and you're just okay with maybe a lower return profile, or you go all high risk and just roll the dice.
And keeping this in mind, and
not investment advice, by the way.
Well, and I'm thinking that the points here, the underlying thesis is diversification. Yeah, that's that it's always true. It's kind of evergreen, but I think it's in uncertain times when risk is it's not just a like intangible thing. It's like you could see things going wrong or potentially going wrong everywhere, that you better know the nuts and bolts and the knobs to twiddle to get the right amount of risk that you're comfortable with.
Yep. It's all about finding the pursuit of the efficient frontier. Getting a really strong Sharpe ratio, and that's all how it fits into your broader portfolio of stocks and bonds and other stuff. So it's a good thought exercise, a way to think about things, but also just the pursuit of trying to quantify. Sometimes in real estate in the past, it's been sometimes harder to quantify these things because sometimes there's not like the data. Like we don't always have like good cap rate data or transaction history. That's getting better over time. But being able to put some actual numbers, and this is where I'd love to get the actual data from this report, and so we could actually look at some of their analysis on those pairings. Or maybe we're just going to have to do some of it ourselves, Matt.
I know, and it's not impossible. Maybe we will.
Nothing is impossible.
Oh, not at all. We are in contact with Mike Leahy, so I shot him an email, and we'll see what he says.
Has he gone back to us?
Not yet. But I want to. I have contacted him. I'm not in contact yet.
And it was like an hour and a half ago, so it's okay. We'll give him a grace period.
Yeah, that's right.
But no, it's a great report, very thought provoking. And again, I just like to dive into the details.
Yeah, totally.
Because it's really interesting. Matt, what did I miss? I was on spring break with the family, and then I was down last week, sick. What did I miss? What are some highlights? What should people go back and watch on the last couple episodes?
Basically, it was setting up what I said it earlier is like we were in this really strong position coming into this current period of uncertainty, and in one episode and in a couple episodes I talked about how there are serious challenges. There was some apartment list rent growth data that showed like, all right, we're still at dangerous levels, and we're underperforming basically when it comes to rent growth. But then that was kind of followed by more optimistic information from RealPage and Yardi Matrix showing that there's some momentum to the market, and I'm actually probably a little more optimistic when it comes to the underlying fundamentals behind that momentum. That makes a lot of sense, especially as supply is waning. So that's what we tried to do. We talked a little bit about tariffs because they're unescapable. But just getting a sense of where the apartment market is and how it is actually changed in a positive way was really important. And that being said, like I did spend some time talking about how this is in the short term. You can't get around how there's going to be challenges. Like I don't think that this current uncertainty in the economy, we're going to get around it in peak leasing season in the summer. So if that translates to reduced rent growth, that's going to be super interesting. That's the hugest question mark that I have is are we really going to see something that cuts into rent growth during the summer?
So we're seeing. Craig Will just made a post on this on LinkedIn. We're seeing average lease length being longer than historically than historical averages. We're also seeing, this is more of an anecdote from our own portfolio, but I've also read some reports, and so I'd like to do some research on this for next week. Is renewal rates are up.
Okay.
We're renewing. We're making an effort to focus on renewals, but we're renewing at like a 60% rate. And other properties that we've looked at are also renewing at above 50%.
Yeah.
Average renewal rate is usually, if in the industry, is 50%. Half the people stay, half the people leave in a given year. We're seeing higher, people are staying in place.
Yeah.
And so between renewing, staying in place, but also when you're signing that lease, people are signing a longer term to lock in that price because they don't want they're worried about rents moving.
Yeah.
And so they want to lock in, and I think they're looking for some sort of like stability of like, I just know what I'm going to be paying over the next 2 years. Even maybe that longer term lease, there may be a little bit of a premium on it. Some people think you can get it cheaper, but it actually could cost the operator, but you can miss out on rent. So you want to bake maybe some more rent increase into the overall rate or an escalation. I think that all plays into the fact that people are uncertain and they don't want to make a decision. So like, let's just stay in put, or once I found something, I want to be here for a while.
Yeah.
But that lowers vacancy, typically increases occupancy, and with more renewals, it brings on a push to increase rents.
Yeah.
And so for those that are have to find something, have to move, they're going to be facing an environment where rents are moving upward.
Yeah.
And barring a recession, which likely, coin toss,
Yeah.
that can certainly put a damper on things. But outside of that, I think we're going to see some strong rent growth this year. Not crazy rent growth. I think we're going to get into I think we're going to see maybe trend this year. And I think we're going to see above trend next year. So like 2.78 to 3.2 this year.
Good.
5% in 2026.
Yeah, and and this is another. We noted this a little bit. 4.5. That's pretty good. I kind of hinted at this earlier, as I also think that we're going to see bifurcation. We're going to see a bigger gap between the higher performing multifamily markets and the lower performing multifamily markets. So, supply is still relevant in 2025, and in the ones where the supply wave has already receded, we're going to see a recovery there that's a lot quicker and showcases these markets' strength a lot quicker than maybe like Sunbelt markets and stuff like that. So we'll be tracking it.
Wonderful. All right. Well, one last thing before we go, make sure you're signed up for the Gray Report newsletter. You can go to grayreport.com or graycapitalllc.com. Another thing that is going to be fun, exciting, we're going to do is want to talk to some more folks that are in the middle of capital calls.
Yeah.
I think if you're willing to talk to us and kind of tell your story, you don't have to necessarily name names, the syndicator, the property, but there are so many multifamily LPs right now that are going through capital calls, and I'd love to just I'd love to hear from more folks about how they found the deal, how they met the sponsor, what kind of due diligence did they do?
Yeah.
What was the communication like? Just tell me the story. And 9 out of 10 of these people did all the right things. They didn't make any gross errors.
Yeah.
Or at least not judgment calls that other investors were doing. They were doing things that most relatively savvy investors were doing.
Yeah.
But they just got caught in the wrong markets or bad timing. Some didn't do due diligence, or not enough.
Yeah.
But yeah, so if you're in a situation like that, or if you've been through it recently, reach out to us. Get in touch with Matt at graycapitalllc.com. And I'd love to host you for a short interview on the podcast. We don't do a whole lot of interviews, so this would be kind of like a special OP thing. So pretty cool. Sign up for the newsletter, subscribe, like, and we'll catch you on the next episode of The Gray Report.